it's a mixed show from Shriram Finance with NII seeing an uptick of 10%, but there was a decline in NIMs. Varun is here to help us understand what went wrong with Shriram Finance. Varun?
Definitely. So it's been a mixed quarter for Shriram Finance. Actually, if you look at the overall NII and PPOP of the company, that is less than what we were expecting. The NII growth has been around 10.3% and the PPOP that has gone by around 8.8%. But if you look at the profitability, that is almost a little bit better than what we were expecting. We were expecting the profit to come at around 2135 crores. It has come tad above that, that is around 2156 crores. If you look at the overall AUM growth of the company, we are expecting the AUM growth to be around 15 to 17%. It is in between that, it is 16.6%. So it is actually on the upper end of what we were expecting. We are also expecting the overall CV sales to actually go down, the passenger vehicle sales to go down. But if you look at the overall CV and passenger AUM, that has gone up by around 12.2% to around 23.17%. That is for the PV. For the CV, no doubt, we have to get a clarity from the management whether it's the used CV segment that is doing good for the company, or have they seen any improvement in the new CV segment as well. If you look at the overall other segment, the construction equipment, that has gone down by around 3%, and also the gold loan business, that has gone down by around 18.8%. Also, we were expecting some improvement in the overall net interest margins for the company. We were expecting around 10 to 15 basis point improvement, but in fact the net interest margins of the company have gone down from 8.25% to around 8.11%. Basically, we were expecting an improvement because there were liquidity issues in the company earlier. Because of excess liquidity, the margins of the company were under pressure, but even this time the margins of the company are under pressure. So we need to understand from the management whether it's the excess liquidity that is still haunting the company, or is it something else which has impacted the overall NIMs of the company. So the net interest margin, they are less than what we were expecting. The overall NPA numbers, they are fine, no spike in the overall NPAs, but yes, the NII, PPOP, that is below estimate, the profit is above estimate. So it has been a mixed set for the company. Let's wait and watch for the management guidance as well.
Right, okay, awaiting the management commentary. But Sunil, wanted to understand what's your opinion on what's happening with NBFC, especially after that very cautious sounding commentary coming in from Bajaj Finance, the mixed bag that we've had from Shriram. Can one deduct right now, so early on, that it could be a sectoral issue wherein there is going to be provisioning issues, and it clearly seems that the rural recovery as well as the SME and the MSME segment is problematic. Could it be a sectoral issue, or do you think it's more company specific?
I think it's basically two things. I think one is that we are going through this rate cycle change, right? With RBI announcing a huge amount of rate cuts, and banks are trying to reduce the rates, NBFCs have to keep up with them. So that's one issue, because the rate cut scenario passing on, because actually if you look at some of the bank numbers, their deposit growth was ahead of expectations. So that's the second point I want to bring in, that customers are still not willing to take whatever money the finance minister gave them and spend it. They seem to be saving it. So seeing it in the SIP book, you're seeing in the savings accounts of the banks. So the banks are actually getting good CASA flows, good deposit growth, and they are trying to reduce rates on the lending front. And the NBFCs, because they are ultimately dependent on the market borrowings, they don't have the benefit of a CASA book or anything for them to get. And they can't tap directly into savings of the retail mass in India. So to that extent, their NIMs will be under pressure, and the lending book until the customer chooses to spend. But I'm optimistic about the future, because we have the festival season coming in earlier this year, and people's purchases tend to get bunched around festivals and Diwali and all that. And these counters, NBFC counters, are very good at the retail end, at the shops where these purchases are made, they convert quickly. So I would still remain optimistic that in the coming quarter, they would be able to grow their loan book quite well, and the NIM pressure will continue for some time, because banks are going to be breathing down their necks. So to that extent, that's why I said this is a transition period, because with the sudden rate cuts announced by RBI, the customers are expecting a sharp drop in interest rates. And how fast can these NBFCs reprice their liabilities, right? Because they have raised liabilities at slightly higher cost ahead of this time, and now they are finding the rates under pressure. So it's a period of a couple of quarters that there will be this readjustment phase. But once the festival season kicks up, I think these numbers should then pick up. On the asset quality front, yes, what Bajaj Finance said in terms of asset quality, that is anticipating pressure, has been a kind of a warning. Nobody expected that. That's probably where. So that we have now wait and see whether other NBFCs are also giving the same commentary on facing a pressure on the NPAs and the collections. But I would say one swallow doesn't make a summer. We don't have to rush into that judgment because banks' NPAs have been by and large under control. I don't think it's been too much bad news there.
So, Sunil, a question really, and purely from an investor perspective. If one has to put fresh money to work, is it quite an obvious choice there? It should be banks versus NBFCs, or would you say use this decline in NBFCs perhaps also to add positions?
I would say that it's banks versus NBFCs. Don't rush into the NBFCs. Wait for the commentary from the whole pack to come in and wait for the numbers from the festival season to trickle in to see whether sales are booming because then you can correlate it to NBFCs lending there. But banks are a safer play because not only do they have the benefit of deposits growing there, the second advantage they will have is almost all of the big banks are distributors of mutual funds and insurance. And if the customer is saving instead of spending, then they're going to be beneficiaries of that from a fee-based income. So at this point in time, I would say the banks are a better bet in terms of that versus the NBFCs.